According to Bank of America, investors are getting a well-deserved rally in the stock market over the next few weeks. The bank's bull-bear indicator recently fell to a 2.0 buy level. Historically, this has led to a strong 3-month forward return for the stock market. And the last time this contrarian buy signal flashed was on March 18th, 2020, just a few days before the stock market bottomed with the onset of the pandemic. The BofA bull-bear indicator has flashed 8 buy signals since 2013, and since 2002, the signal has generated a median 3-month forward return of 8%. However, also according to BofA, any rally in the stock market should be viewed as an epic selling opportunity because BofA believes an ongoing shock in rising inflation and interest rates will negatively impact corporate earnings growth. In other words, this means the S&P 500 is more likely to trade lower following the rally. BofA states that asset prices are driven by 2 things and 2 things only: rates and earnings, and both will have some problems in the future. And what's interesting is that I told you about 1 to 2 weeks ago we need to watch the long-term chart as it's showing the possibility of a downtrend. So, let's take a look. And today we're going to take a look at 2 quick charts, beginning here with the Dow Jones Industrial Average ETF, and the symbol is DIA, or the diamonds. Now, as we've been talking about, we're finally getting that W formation that we've been looking for a long time. Now, it's relatively ugly, but that happens when a war starts. Now, you can see that we're up to this level here. We're not quite to this level. We'd like to get up there, and I think we will get up there, but there's a possibility there may be a hesitation as we reach that level here, at least in the Dow. But ultimately, we're looking to this level here, just under 370, which would be the same level as the previous high over here. So between this time here and then up to this level here is where I think there is some danger and it's lurking. Let's go take a look at the long-term chart and I'll explain in more detail. And now we're looking at the 20-year monthly chart on the diamonds, the DIA. And as you can see up to this point here, that was a previous high. We came on down. We're getting a reflection. We're going to head back on up here. And so the danger lurks between now and this potential double top. But I also call it a backside spike. And I'll show you why in the oscillators a little bit later. But we can take a look at another backside spike. Here was one at this point here. We came on down. We reflected back on up and hit a double top. And then we fell down to this point here. So that's what I'm looking for. There's other examples, such as perhaps this one here, the previous high. We came on down, we came on up, we failed, and back on down. That wasn't too serious, but it did take some time. Now, there are other examples. Going back here to 2007, we had that top there. We came on down here, we moved on up, it failed, and then we fell all the way down here. I don't think that we're going to have a crash the size of the Great Recession, but I think we could have some trouble coming up. And let's take a look at it. Moving down here into volume, that's not going to show us too much, but here it's basically all in the MAC. Now, if you look at the current formation, we've had this top here that certainly looks like it went sideways and then rolled over. We're down below. The fast line is down below the slow line, and the fast line is going to want to come back on up here and hit another high. But that's where the problems can lie, simply because this move on up here is weaker than certainly this move all the way through here. So this weakness can actually turn and then break, and down you can go. So looking back here, again, this is this example, the first example we showed. This came on down here. The fast line did not actually go through the slow line. It reflected off of the slow line. It came up here and then moved on down. So basically, this second move here was weaker and it broke. So that's what I'm looking for, a possibility here in the near future, is a weak move on up and then the break. Now, let's move on down here into the histogram. You can see that things have definitely turned over and we've slid pretty far pretty fast. We're going to get a recovery back up here, perhaps above that zero line, and then we'll see what happens. But I think the backside spike is what I call it, is a little bit easier to take a look at in some of these oscillators, including the price rate of change. Let's go back to this previous example. We had the high here. The fast line came down below the slow line, and then it reflected back on up to this point here, and then it failed. So that's the possibility. We've come on down through here, fast lines through the slow line. We're getting this reflection, this sawtooth move back up here, that spike. And wherever the slow line happens to be, say something like that, we could come up to this level. It could reach the slow line, it could breach the slow line, but if it's a weak move, there's the possibility that it can break and then head on down. So this is a good example here, 2018 to 2019. You had a few examples here, 2007, that move there to that move here, and then we came on down, and then we actually had another probably a little bit better example of a backside spike where it came on up, it was weak, and then it broke, and then down we went. Let's just see if we have some other examples. You can see it in the RSI, certainly here. This top there, slightly weaker, and then much weaker here. We broke here, and then we also broke here. Into that 2017, 18, and 19, there was that move there, came on down. Certainly this move here was much weaker, and then we broke. So definitely you can see that these sawtooths are weakening, and if we get another one and it breaks, we can head down below 50. So that would take the market down quite a bit. You can also see it here in the stochastics. This slight move here, if we do move on up, it can hit and possibly break, as it did at this point here, breaking down in there. And certainly back here in the Great Recession, this one broke, and then this probably better backside spike broke here and headed on down. Into the Williams, you see pretty much the same thing there. So I think you get the idea. Moving back on up to the price chart, one last look. Definitely that is a possibility. It's not the probability at this time, but we need to take a look at the forward movements of these formations to see what possibilities may occur, and a failed move on up is a definite possibility. So we'll be watching out for that. And for today, that's ChewDog Charts. Thank you.